Hello everyone. In today's video, I will be providing some background on what is happening in the investment grade corporate bond market, and then also talking to you about the credit facility that the Federal Reserve created. So if you're new to the channel, please know that I work on financial videos that cover the stock market, the economic activities, and also other relevant financial news. If that sounds interesting to you, then please hit that subscribe button as well as like the video. So let's jump straight into it. So for some background, here is a chart on LQD. This is a major ETF that you can actually buy, and this ETF, they actually invest in investment grade corporate bonds. So LQD, as you can see here, they actually fell about 22% from peak to trough in just under a month. And if there's anything about the bond market that you should know, is that this is actually a very drastic move for the bond to be dropping 22% in just 1 month. So ultimately what happened was the Federal Reserve came out with an announcement back in late March. This is on March 23rd. That's when they actually started to announce that they're going to be working on something called the Secondary Market Corporate Credit Facility, SMCCF. And ever since then, the LQD has actually rebounded quite a bit. So let's kind of talk about what exactly, why exactly did they do this, right? So the Federal Reserve, that they announced that they are working on this credit facility mainly because of the spread of the coronavirus and how it has been affecting the financial markets. At this time, as you can imagine, there's been a lot of volatility in the market, both for equities and also in the bond market. And usually what you can expect is that the bonds and equities should have negative correlation, but at this time in late March, everything was selling off. And generally speaking, if this happened, a lot of these corporations were not able to raise the cash that they needed. Everyone was dumping bonds in order to get cash. And one thing that Powell really stressed was that he wanted to make sure that the market was functioning properly, and that companies can borrow, people can borrow, and essentially, if companies were not able to borrow the cash that they needed, they would have had to take in cost cutting measures, such as laying people off. So the next part here, I want to talk about how essentially these companies, they needed to obtain financing in order to survive. Otherwise, furloughs or even layoffs would have happened. And this would have happened to even the highly rated companies. They just needed liquidity to really survive this time. And the reason why this matters is because ultimately, as I showed earlier, the LQD, if the price is dropping, essentially what that means is that if the corporations want to issue new bonds, the yields on these bonds would have been much higher, just because investors were demanding much higher yields given the uncertainty with the coronavirus. So the next part here is that, even very well-known companies such as Pfizer, a Microsoft, and an Oracle, these are investment grade corporations that the Federal Reserve would be buying up their bonds. And in case you guys are wondering, the Federal Reserve will actually be buying up to $250 billion in corporate bonds from eligible issuers. And ultimately, the goal here is that if banks are much more likely to lend money to corporations if they know there's a strong secondary market that they can actually sell into, which is why the Federal Reserve created this credit facility. So in case you're wondering, I put together kind of like a chart here to show who are the eligible issuers. As you can see, eligible issuers are really corporations that are at least an investment grade rating. Now, if they did fall below investment grade, what is known as fallen angels, into the non-investment grade, if that happened if there was a downgrade to these companies after March of 22nd, the Federal Reserve would still use that credit facility to buy them up. But the main thing to keep in mind here is also that all these individual bonds purchased by the Fed must actually have a maturity of 5 years or less. So here's an interesting table where it really just shows you how, in terms of what the Federal Reserve has been doing so far, they're actually planning to update this information on a monthly basis on their actual website. So I quickly kind of sorted this out to show who are the top companies that the Federal Reserve has been buying from. And you can see here, these top 10 companies, this is your Toyota, Volkswagen, AT&T, as well as like Apple and Ford are in here. And these top 10 companies actually make up 15% of the total credit facility so far. Now, again, by what the Fed is doing here, by lowering the return from investing in bonds, ultimately what the Fed is trying to do is to really encourage investors to shift money from corporate bonds into stocks, right? Because if the Fed is buying up bonds here, if they're buying them up, they're actually pushing the yields down on these bonds. So investors actually won't think that's as attractive and actually want to go put money into like the equity market. And, you might be wondering, wow, why does a company like Apple even need to issue like corporate bonds? Well, at least for Apple, they actually were able to really take advantage of really, really cheap financing, almost getting about pretty much like 1% to be able to borrow about 8.5 billion in bonds so that they could use it for stock buyback. Other companies that you might be very well known of is like Ford, also issuing $8 billion in debt, as well as in late April, Boeing actually had pretty strong demand for $25 billion that they actually were able to sell. So in terms of what this actually means for investors, like the Federal Reserve really is trying to be helpful here, just really given the uncertainty of what may happen later this year. One of the things that the Federal Reserve has mentioned that they really want to make sure that companies have all the money that they need to really weather throughout this pandemic. And as the Federal Reserve is buying, they're really making this anonymous. Like these corporations are not asking for help. The Federal Reserve is just randomly buying up these corporate bonds. And one key date to keep in mind is that this credit facility by the Fed to buy these investment grade bonds will actually end after September 30th. So that's actually something important to actually keep out. So overall, thank you very much again for watching the video. If you thought it was helpful, feel free to hit that subscribe button as well as like and share the video. If you put a comment below, I promise you I'll respond back. Thank you everyone for watching and have a great day. Thanks. Bye.